What's going on, guys? It's Matt Fractal back with another video. As you know, we get straight into the video. Let's do it. So we're starting on a dollar index chart on the weekly time frame. I want to bring your attention to this order block here on the weekly chart that was created on June 30th. All right, we're trading at the opening price of that candle here. So this is gonna make more sense as we go down to a daily time frame. But last week we started here, we traded down, we made a little tail up, trading into the week prior's closing price. As you can see, we opened, traded up, tagged that price, and then we traded down into a order block. The last down close candle before this two up candle. This two up candle, it breaks this down close candle, so this becomes a bullish order block, making the algorithm susceptible to bullish pricing when it gets tagged at this specific price point, right? So let's look at it on a daily time frame. On a daily time frame, it translates to this down close candle. People are going to ask, why isn't this down close candle the order block? These last two down close candles, look at the bodies. This body is larger than this candle's body. So just always go with the candle that has the bigger body. As well, the weekly time frame also translates to this candle. So this is the order block. Order block gets tagged here on Thursday of last week, the 24th, and we tag it, and then we rally for Thursday and Friday, right? Why did we rally for Thursday and Friday? Because we made the low of the week on Thursday with this little tail on this up close candle. So we traded down, right? Let's see if we traded down into this candle here. So yeah, we did. Even though this is the order block, algorithm is tagging this little candle, but as you can see, it's inside of this body, right? Taking this body's range, moving it over to the right. This candle is still in this body. So I'm going to still use the bigger candle as the order block. Thursday low of the week, up candle on Thursday, up candle on Friday. We're trading here on Monday. As I just showed you on the weekly time frame, it's on all time frames because price is fractal. So this down close candle on a daily is now going to be susceptible to being a bullish order block. So Monday right now we opened, we traded a little bit lower, tagged into this um high of this candle, and now you can see that the candle is turning bullish. So we'll see later into the London session and the New York session what is the bias and the direction for the dollar index. I'll just let you guys off with this. Since we created that low here, I'm looking back into this range from this low to this high, and the 50% is probably right here. So above that, I can see we have this up close candle, which is bigger than this one. So I'm going to use this one as the bullish order block. No, sorry, the bearish order block. Down close candles are bullish order blocks, meaning when we trade down to down close candles, we want to go up. Up close candles are bearish order blocks when they get broken. So when price trades up to them, we want to see if we react lower or break through it to clear out the high. So I'll draw this out just for your study. This is an important price point for this week. Going down into the hourly chart, just to show you guys the full basis of this video, which was on Friday. So as you can see, this is how we look on the hourly. Now this is just price. You know, we're time precision FX, so we trade with time being number one and then price being number two. So we have our price, but as we said, time is first, so we have to mark out our time. So let's just mark out Thursday, New York Open. We'll mark out Friday's New York Open, and we'll put today, well, today's Sunday. We're going to be going into the Monday opening, midnight open for the Monday's price action. So Thursday's price action, Friday's price action, right? We are already on Thursday and Friday looking for bullish pricing because we know that we created the potential low of the week. So Thursday gives us that bullish move and it confirms it by breaking the structure here and here, right? Now I can say the dollar index is bullish on the hourly chart. When we run down here in London on Friday, the 25th of July, and we run below this swing low here, this swing low pattern, let me just draw it out for you. We run below this swing low pattern here in a time, an important time, a kill zone, London Open at 2 a.m. New York time. So this is an important trigger point for a entry. We run below an O low in London. What's the next step that I've been teaching on my YouTube channel for the last month or two? During an intraday price action, if we're bullish on the daily chart and the weekly chart, when we come down to the hourly chart, we want to look for runs on the sell stops, the stops that reside below old lows, like this. So we tag it, and then on a 15-minute chart, which we're going to go to now, we want to look for the opposite end of the range. What does that mean? Where is the nearest old high contrast to this old low being taken out? So old low gets taken out on the hourly. That's a trigger point because we're bullish. We want to see old lows taken out. Then we go to a 15-minute time frame and we look for the nearest or the range high from this old low. So if I go back into this price action, right, we have a high back here from this high to this low. This is a range. So let's draw that out. And if I look back here, we have these two highs. What did I tell you guys? When a high fails to take out the old high, but we're still bullish, these highs become a relatively equal high, a relative equal high. So we're going to just mark out this full range right here, this full. And what did I say? Above old highs, we have the buy stops. Below old lows, we have sell stops. So now we have a range and we have a concept, an algorithm, a fractal model. Price is taking out old lows in the London session. So now we have time, London session, and we have price, old low. Bingo. That's a check mark for your strategy. The two most important things, time and price. London open, old low. Go down to a 15-minute chart and we mark out the range. This low to this high. Cool. Now we go down to a 1-minute chart. And now this is where we look for our entry pattern. The entry pattern is basically a rally above an old high. So this is breaking structure here. Once we rally, strong move up, right? This is a strong move. Mostly green candles and it's pretty quick. As well, we're breaking this old high here. So once we break that quickly, strong move up, we look for a retracement lower and we get it here around at 3 a.m. Still the heart of the London Open. So we're going to grab a Fibonacci retracement tool and grab it from that strong move up, which I'll just grab it from here and we'll bring it up to the high. So from this low to this high, that's our strong move up for the range on the 1-minute chart because we broke the structure and we're still bullish on an hourly, a daily, and even a weekly. So when we're trading back below on a retracement into the 62% right here, right? Below the 50% is a discounted price. So if I'm bullish, I want to be buying in discount, but I can't really buy in discount on the hourly or the 15-minute chart as well as the 5-minute chart because I'm not going to know what to do, where am I getting out at? But once I create the range on the hourly chart, or once I get the model for the sell stops on the hourly chart, go down to a 15-minute chart, create the range, I know where I'm getting out at. I know where I can place a Fibonacci tool on a pattern. So we get that right here. Strong move up, we trade down into that 62 to 79%, and we buy it here. Now, where do we get out? That's one of the biggest, you know, questions I had for a while. Where do you get out when you get into the market? Because sometimes you don't know, is price going to go on forever, or is price going to just go take out these, these stops above here and then reverse? You never know. But once you create that range, you have a clear idea where you're getting out at, which in this scenario, you're buying it here. Your stop loss goes below the strong move, and then you're exiting above or near the buy stops that you drew up on a 15-minute chart, right? You can get out above, you can get out close to it, or you can get out near it. Doesn't matter. The goal is to clear out the 15-minute buy stops in a bullish model. So as you can see, getting out here, you would have profit, but waiting, going into the New York session, you would have been able to capture a greater move, more reward for the risk that you put on your trade. So hopefully, that shed some light on this strategy. Sorry for the audio. There's a lot of things going on outside, but you guys stay active, all right? Fractal out.